Hi guys, welcome to CA Inter Financial Management MCQs. We are starting away with the chapter of dividend decisions. This chapter is normally important, not very important, not very unimportant. Okay, but it is important as far as your examination goes. And questions over here are going to be quite small. Dividend decisions is all about how much dividend a company should be giving. Should it be giving more amount to the shareholders that ends up in company having lesser figures? Or should it keep more amount for itself and give the lesser amount of dividend to the equity shareholders? This ensures that company has a lot of money for its growth further. But everything has a drawback also. Let's start it off with the question for today. Just one small thing. On every Saturday, Sunday, we are coming out with complete syllabus of costing. Complete lectures. Okay, complete lectures mean whereby every question of module is covered, homework section. Apart from that, there is a ranking of every question, the summary of every question. Tests are done at the end of each and every chapter. There is nothing more that anybody can be doing for you as compared to this. Okay, this will ensure that you all can easily get 90 plus in costing. Okay, so do tune in on every Saturday, Sunday on our YouTube channel. Okay. With this, let us start it off. Our question for today is, which one of the following is an assumption of Gordon's model? Okay. Gordon had made the formula for KE, no? So, first assumption, KE is greater than G. Retention ratio B, okay, one set is constant, okay. Then, the third one over here, firm is an all equity firm. And lastly, all of the above. Now, Gordon gave us a formula for calculation of KE. He told that cost of equity is dependent upon the dividend that are expected by the shareholders. In case you all know the answer, this is the time to be commenting, please. Okay, now see, Gordon's formula was all about calculation of KE. He told KE is equal to D1 upon P0 plus G. Now, D1 is nothing but the expected dividends by the shareholders. P0 is the current market price. And G in this case is nothing but the growth rate that the company is anticipating. Okay, now growth rate will depend upon the performance of the company, right? Now, in this entire formula, obviously every formula has a lot of assumptions, especially in FM. So this theory was made around few of the assumptions. But before that, G is calculated as it is B into ROE. B is nothing but the retention ratio. And ROE, or some people call that as small r, okay, is a return on equity that the company is expecting. Now, he had told that G is going to be constant. Now, G will be constant when B and ROE are constant. Okay, ROE is a return on equity. So, ROE had to be assumed to be constant. ROE will also be constant when the return that the company is earning on its business is constant. That is, the IRR is constant. I framed a list over here of all the assumptions that are there. Okay, the first one. The first assumption that is there is that firm is an all equity firm, and that itself means there is no debt. Now, this formula assumes that there is no debt. Okay. To be very honest, this formula we all have applied for every question wherever there is debt also. Okay. But there is a limitation of this kind of a formula. Okay. Now, Gordon could not have integrated equity and debt at the same time. So, therefore, he made a formula considering that the company is an all equity firm. Okay. Second assumption that he made, growth rate is constant. Okay. As I told, growth rate will be constant when the company is earning same rate of return on its investments. That is, IRR of the company is constant. Third one, retention ratio once decided is constant. Okay, that is constant dividend payout ratio will be there. So B is nothing but the retention ratio. Okay, you all will understand retention ratio is the amount that we all are keeping with ourselves. Example, the dividend payout rate is suppose 60%. That means whatever the company is earning, 60% it gives to the shareholders. That means 40% it keeps with itself. This 40% is nothing but the retention ratio. So if G has to be constant as told in assumption number 2, okay, obviously in this case, even B had to be constant. That's what I told right now. Then fourth one, this assumption is crucial. Okay, that is KE is greater than G. Cost of equity should always be greater than the growth rate, because if this is not there, P0 ultimately will turn out to be negative. You all have done that in one of the questions also. So therefore, if you remember the derivation that we all have done for calculation of KE, KE keeps on getting compounded. Okay. So if you all remember the derivation that we all have done, D1 keeps on getting discounted by KE, but keeps on getting compounded with the help of G. So in end, there is net discounting to the extent of KE minus G. Those people who know the derivation, those guys will understand this thing. Okay. So this assumption was required. And if this assumption is not met, to be very honest, P0 always comes negative. That is something that's not possible. Okay. So that is a fourth assumption. And fifth one, all investment proposals are financed through retained earnings. Now, when Gordon had made the formula, he did not want cost like flotation cost to be affecting his formula. So therefore, he made a simple thing. He made a simple assumption that all investment proposals, all the expansion plans will be financed through retained earnings only. That was his assumption as such. Obviously, we try to modify the formula for equity also, to be honest. And instead of P0, we try to be taking net proceeds. But his original formula had ensured that there is always concept of P0. That is, in this case, there are no flotation costs. These are the 5 assumptions. Okay. Now, as far as the answer goes, which one of the following is the assumption of Gordon's model? I guess A is an assumption. B, retention ratio once decided upon is constant. Correct. That is also an assumption. Firm is an all equity firm. Yes. So therefore, answer should be D over here. That should be the correct answer. Yeah, that is the correct answer. That's it from my side for today. I'll see you all next time with another MCQ in your next lecture. Till then, take care guys. Bye.